You have a really interesting background. You were a lawyer for, it seems like, almost 2 decades at Kirkland and Ellis.
Yes,
Um,
yes.
you worked on some really big deals there, and then you moved way down market and you bought a series of software businesses that you rolled up with a partner, sold to Alpine, I think very successfully. And how did you move from the big deals that the really like focusing on the big deals to moving way down market? What triggered that
Yeah.
interest
So
for
it's
you?
always funny because it feels like it was a very natural evolution. But I realize, having heard what you just said, and it's all true, that it may seem a little bit disjointed. So let me connect some dots. So you're right. I worked at Amazon for a couple of years and then went to law school. And then I went to work for, one of the nation's top law firms that really is best of breed for doing uh, transactions for large private equity firms. And I worked there for a number of years. I ended up staying there for 17 years. And two things happened. First, I started to, I was doing a lot of these deals. And a lot of these deals over the past 15 years in private equity land, they're roll-ups, right? It's a private equity firm going into a highly fragmented space, B2B enterprise SaaS, home services, and they go in and they make an anchor investment. Then they start doing bolt-on acquisitions, right? And they try to grow the platform two ways. First, just organically, right? They try to have an operator in there who truly is good and is able to create operational effectiveness. And so what that means is they're able to grow these businesses organically. But then they try to accelerate the growth by doing this bolt-on M&A. And I was doing these deals for sponsor clients as they were doing these roll-ups in a bunch of different industries. Think of Vista and Thoma Bravo in the B2B enterprise SaaS space. Think home services. So I was seeing that up close. And then I was also an investor in a lot of these private equity funds just as a passive limited partner. And I started to notice something. I probably practiced at Kirkland for 6 years or so. I'd made partner. Um, and I was seeing how these roll-ups uh, could really translate into multiple expansion. And multiple expansion, of course, is the idea that if you buy small things, you're likely going to pay a relatively small multiple of cash flow from a valuation perspective. If I buy $1 million EBITDA business as an example, I can buy that at 3 or 4 times EBITDA. If that asset is worth $5 million of EBITDA, I'm going to have to pay up for it. I'm going to have to pay 7 times. If it's 10 million, I might have to pay 10 times or 12 times, depending on how quickly it's growing and depending on what industry that it's in. And I was really enamored by this idea of multiple expansion. Warren Buffett often says that compounding is the eighth wonder of the world. I'm pretty certain that multiple expansion is actually the eighth wonder of the world. And because it just has such a significant impact to juicing your equity account when you go to sell the platform. And so I was seeing this up close and I was sort of scratching my head and saying, like, there's something really interesting here. I'd love to figure out a way to capture some of that value as a principal, not as a deal lawyer, but actually get more involved in one of these roll-ups as a principal.
If you run a holding company or business with multiple entities, you should definitely listen to this. At Enduring Ventures, we have over 50 bank accounts across our different portfolio companies. Our director of finance, Nick, spends every morning going through those accounts one by one and making sure that the cash balance is where he expects it to be. This used to take him an hour or so every single day. There really wasn't an easier way to do it. Then a friend of mine introduced me to Vesto. Vesto makes it easy to connect all of your bank accounts into a simple dashboard. So you get real-time balances, transactions, and cash flow monitoring all in one place with just one login. So Nick got to go from checking 50 different accounts to just checking one account and one dashboard every single day. A job that used to take Nick almost an hour every day now takes him just a couple minutes or less. If you're managing multiple bank accounts, Vesto is a no-brainer. Go to vesto.com, tell them that Sieva sent you, and you'll get to speak directly to the founder, Ben.
I wanted to do this while staying at my law firm, but having somebody who I could rely on who could run this business day to day. And as luck would have it, through a lot of coffees and conversations, I met somebody who had previously bootstrapped a small SaaS company. He had sold it. When he sold it, he made, pretty decent money, not enough to retire and live on the beach, but he clearly had demonstrated that he knew what he was doing. His background was in computer science. And he said, listen, I'm thinking about, he went to work for the buyer of his business that was a private equity firm, spent 2 years there doing integration for Rollups as well. He said, I'm thinking about leaving my job. I want to go out and build something new, but instead of greenfielding it, I want to do some deals. And I said, man, that's so great. This is like exactly what's been in my mind now for about 18 months. We should think about partnering together. We spent a lot of time, just talking about whether we would be good partners and whether we had skills that were complementary. And we had a lot of conversations externally, sort of in the community, to sort of develop our thesis. And after about 6 months, we decided to go ahead and do this together. And we had a very specific thesis. And the thesis was, in talking to a bunch of bootstrapped technical founders of these small SaaS companies, we decided that we wanted to focus on SaaS. We started to identify this theme that we heard over and over and over again. And that was, there are a lot of bootstrapped SaaS founders who have been able to grow their business to $500,000 to $2 million of top line revenue. And they're running a high quality business. They don't have a lot of churn. They've got pretty good margins. So these are good, sticky little businesses. But what we found as we sort of dug into the situation a little bit further is that a lot of these businesses, they actually weren't growing much. And it wasn't a matter of them not growing much because they weren't high quality. Again, the fact that they had gotten to $500,000 to $2 million of revenue with low churn, that was a clear demonstration that they had great product market fit. They had a very sticky customer. They were clearly delivering a high value proposition into the market, a high valued proposition. But what we learned as we continued to dig deeper was that there was almost universally something that had happened in their life. Maybe they got married and they wanted to buy a house. Some of these guys want to continue to build new things. They have new ideas. They're serial founders. So one of these guys wanted to go out and create a new app. But something happens oftentimes in their life. And the net result of that is, instead of taking all of this rich cash flow from their business and reinvesting in commercial execution and continuing to accelerate the growth trajectory of their business, they decide to start taking a lot of the excess cash flow out, and they start running their business like an annuity. And the problem is, it's totally natural for them to make that decision. You and I would make that decision if we needed to take care of things at home. But in SaaS, there's what's called the rule of 40. Sometimes people call it the rule of 50. And basically what it says is, if you're a software company, if you're a SaaS company, if you're a B2B enterprise SaaS company, and you want to try to figure out, well, what's the valuation of a business like that? The rule of 40 basically says that two things matter. What is your organic growth rate? And what are your margins? And if both of those things are high, you add them together, and if they're in excess of 40%, if both of those metrics are high, you're a high quality and high valuation SaaS company. You might be worth 5 times revenue, 6 times revenue, not even revenue, 7 times revenue, an infinite multiple of revenue, as we see sometimes. But the dirty little secret is, if you're low growth, even if you're high quality, if you're low growth, if you're only growing at 1 to 3 or 4% a year, you're actually not worth much. You're only worth 1 to 2 times revenue. And so our strategy was to find a highly fragmented vertical. We ended up focusing on the MarTech space, tools that are used for SEO marketing. And the thesis was, we wanted to go out, we wanted to start buying up businesses, competitors in that space that were low growth, low churn, low growth. We wanted to buy them from an entry multiple of 1 to 2 times revenue. We wanted to go ahead and bolt them together and create this platform. And then what we wanted to do was flip the script on what the seller had done. We wanted to actually overinvest into sales and marketing. We wanted to get that organic growth rate from 1 to 3% up to like 20 or 25%. And our thesis was, if we could do that, what would ultimately happen is that when we went to sell the platform, now at a much larger size, hopefully growing at 25 or 30%, we would be able to sell that platform more at a market normalized multiple basis, 5 times revenue, 6 times revenue, 7 times revenue. And as you know, when you're able to do that, that's what creates that significant multiple expansion. That's what creates that opportunity to have, all of the variance between your entry multiple and your exit multiple really sort of accrue to your equity account, and it can really juice your returns. And so that's what we did in around 2015, 2016. We bought 3 businesses. We used a 7A loan for the first business. We used a lot of
What
earnings.
was the first business? Was that Authority Labs?
Yeah, it was called SERPS.
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 Got it. What was the revenue of that business when you guys bought it?
Yeah, it was pretty small. It was probably doing about $1 million or so of ARR. And then we got to work. We put these businesses together. We're very capital efficient, a lot of earnouts, a lot of seller financing. And then the fun began. I mean, I love to go out and market and sell. And the beauty about this business is if you sell anything online, if you have an e-commerce marketing manager, if you've got a website, if you're a search agency that advises e-commerce companies, you need a tool like ours. Basically, what our tool did was that it allowed you as a merchant to understand how you were performing from an organic search results perspective. And so just to unpack that a little bit, if I'm Foot Locker and a new pair of Air Jordans drops, I want to see when a kid types in new Air Jordans into Google, I want to see where I rank on the Google organic search results.
And ZoomRank and Authority Labs, were they about the same size, about $1 million revenue each?
Authority Labs was a lot larger. It was a multiple of that. So we ended up buying Authority Labs about 18 months into our journey. So that's sort of what allowed us to accelerate getting to scale, because we were able to bolt on that business, and it was much more mature than the first 2 deals.
And how did you guys structure the purchase for that one? Were you able to still use your SBA capacity for it?
Really interesting. So I want to be very careful about this because I know this is very, very hard. We actually did that acquisition all in a seller note.
Wow.
So we were able to buy that business all in a seller note. Now, it required 6 months of back and forth with the seller. He ended up pushing us on the purchase price. We ended up paying a lot more for that asset than we had, sort of started around the negotiation. There were all sorts of conversations, as you might imagine, around credit support. I don't recall exactly how many years we were supposed to pay out that seller note. It was a number of years. Let's call it 5 years or so. The seller was a technical founder who had created other businesses. He also had some shareholders. And so he was probably only spending 8 or 10 hours a week on this business. And so you have to have sort of the right confluence of variables and attributes to make a deal like that work for a particular seller. But in his case, it worked. It was sort of interesting because, the base case was that he would have gotten paid out, a lot of money over, let's call it 5 years or so. We ended up selling the platform about 12 months after we did that deal. And that actually accelerated the full repayment of his note. Instead of getting paid across 5 years, he got paid all of it about 12 months later. So listen, at the end of the day, everybody sort of won. I mean, that's always our objective. This is why, even being a dealer is a lot more fun than being a litigator, because there really is an opportunity sometimes for everybody to sort of win. But that was an important acquisition because it allowed us to much more quickly sort of get to scale.
I'm sure there's a lot of people listening who are going to be curious. How do you get a business on 100% seller note? I think you made some references to how that occurred here. How did this happen? Like, what was the motivation of the seller? Somebody listening to this would say, well, why wouldn't they just hold out and maybe sell it to somebody else? Or why wouldn't they just keep running it 10 hours a week? That sounds like
These are very fair questions. So first, I want to preface by saying, it doesn't happen every day. And I know sometimes you listen to podcasts and it seems like it happens every day, but it doesn't. So there were a few of the other aspects to that were, this is back in like 2016-ish, 2017. Acquire.com wasn't
Mm.
around. There just wasn't, this doesn't seem like that long ago, but the market has actually gotten a lot more efficient even over the past 7 or 8 years. And so in his situation, I don't know that there was an efficient market to take that asset to market with. I mean, he was only probably working in the business 10 hours a week. Private equity probably didn't have an asset like that. And so, it wasn't going to be the sort of situation where a strategic could come in and just take that asset and bolt it on, at least not sophisticated equity. And so, the market wasn't efficient. There wasn't a natural buyer universe. So for all these reasons, I think, and because he was only spending 10 hours a week, I think his perception of the value was probably relatively low. I think for his third party equity investors, this was all option value. I think they had like helped him develop his initial website and do some of the back end. They may have invested a month or two into this entire company, the third party investors from several years ago. And so, again, everything's about human behavior. I think that this was all gravy and option value, which isn't to say that like he would have taken anything for it. He didn't. It took us 6 months of very aggressive negotiation, starts and stops. But eventually, I think that he probably, had other businesses in motion. This was like all gravy to him. And at some point in the process, he was probably willing to take a little bit of risk on the note. There are some things that I always feel like are sleeves off your vest when you structure a deal like that. Like, I'm always happy to pledge the equity in the business back to the seller, right? Like, the idea being, like, listen, we'll go ahead and come up with a payment schedule that you like. You know, I'm happy to put in place some covenants so that there's some cash in an account somewhere. I can make representations once a year that we have that cash in that account to continue to pay you over the next year for your principal or your interest. There are a bunch of things that we can do. I'm happy to pledge the equity back to you. So if I fail to make a payment and I don't remedy the situation, you can keep all the cash that we've given you on this note and you can basically claw back the business, right? So there are some things that you can do to try to give that seller some comfort, but you're never going to be able to fully solve all of their issues. And so it's really a matter of whether you can sort of give them enough and whether you can give them enough of a premium, maybe not relative to the market, but enough premium relative to what they have in their head around sort of their value of the business to at least make it sufficiently attractive for them to be willing to have a conversation. I will tell you though, like I've tried to use that same playbook 100 times since then. Maybe I've gotten traction a few times, but like that was a very unusual situation. And it's always important to me to sort of reflect upon that because if that's the only sort of deal that I try to do on a go forward basis, I wouldn't transact very much.
Yeah, it sounds like catching lightning in the bottle. I've certainly heard about it before. We've actually done it twice, not 100%, but two 90% seller notes. So it's possible there's reasons that sellers do it.
It
That's
also helps too, yeah, in these holdco structures, if you have other assets. We had already done two other deals. I think the second deal we did outside the SBA, so we could encumber that asset
mm,
too. So like, from a credit support perspective, if you've got a holdco, if you've got other assets that aren't encumbered or that you have the ability to lean up, again, at some point, you might be able to provide enough credit support to be able to sort of get that seller comfortable that they have, enough credit support to look to if you fail to make a payment or if you default on your obligations.
so you guys acquired these three businesses, and then fairly quickly, I would say 12 months later, so you sell it to Alpine. What was the group revenue by the time that Alpine was knocking on your door?
So after we did the third deal, a couple of things happened. One, we had a significant win from an organic growth perspective. I had a good friend who actually owned a really large search agency, and we were able to do a significant deal with her. a significant six-figure deal, which ran across multiple years, in a contract. So it would be respected by a buyer. And that had a significant impact on our overall base of revenue. It really allowed us, between that deal and just our normal sales efforts, to really get to a place where we were now growing this business, well north of 25 or 30% a year, which is really sort of where we felt like we needed to get. We didn't think we'd get there for a number of years, but that was ultimately sort of where we wanted to get this platform to. The other thing that happened, though, was every time we did a deal, we issued a press release. And we did it for a couple of reasons. One, we issued a press release for the first deal. Somebody saw that and reached out to us, and that formed the basis for doing that second deal. The other reason that we did it was, from a commercial facing perspective, I really enjoyed continuing to tell my network what we were doing. It really allowed my network to be able to see what we were doing and send me emails and send us emails from time to time and say, oh, you should talk to that guy over there or that woman over there. They're in this space as well. And so what ended up happening was, after we did this third deal, we really put our head down. We were really focused on standing up a sales and marketing team. We had just done a lot of work from a back-end perspective to try to get our tech stack uniform across the three deals. And then we had a significant roadmap on the front end to try to figure out how we were going to harmonize these brands. Some things that we were going to try to do from a product offering perspective. So we got to work on that. We landed that large deal, and then we got an inbound. And Alpine said, listen, we saw the press release for your latest deal. We're putting about $400 million into this new arm called Alpine Software Group, which was actually, it looked and felt like a bunch of platforms, just like the platform that we were trying to build here. And they said, one of the platforms that we want to develop is in the MarTech space. We've taken a look at what you guys are doing. We think it would be, a good anchor for what we want to build in that space. Do you have any interest in selling? And at the time, we felt like, we weren't patting ourselves on the back. We felt like we had good momentum. We felt like we were starting to see the promise of our thesis begin to play out, but we still felt like we had another 2 or 3 years of doing some additional deals and really seeing our product roadmap through. But it was a good offer. And so we started to have a conversation. And after a month, we were able to negotiate a deal that we decided to take. And at the time, Alpine, we didn't know this, but Alpine was running like 7 deals, including for our 3 companies, simultaneously, while they worked to sort of set up this ASG arm. So it was a very frenetic time. It was like at the end of 2017. So we ended up selling the business to Alpine. We hung around for a year. We had an earnout that came due about 12 months later. The earnout was all about further growing the business from an organic growth perspective.